going on, everyone? Charlie here. Hope you're having a good Sunday so far. We're going to talk about the long straddle, and yeah, because we've been really, helping delay the MOAS a little bit. So we're going to look at how to not do that, and yeah, we're going to do that by don't help delay, learn their way, trading volatility as an asset class. So delaying MOAS happens when this shit happens. Look, we had 53.994 call options in the money for AMC. We had 324,579 out of the money. We also had 295,529 puts out of the money as well. So all that is money in the hedge fund's pockets, because that is the premium drain from the purchase point or sell point of these options. So basically, the goal on either side is to have options expire in the money, and this prevents as little premium as possible from being extracted by the hedge funds market makers. So what is premium? Well, premium volatility waves. Let's go ahead and go through this real quick. So if you follow this line here, options are going down, IV's going down, options expire worthless right here. And then what happens? This is when long calls are bought from the market makers. They're likely also buying puts as well, cash secured puts, at the same strike price at the same time for the same expiration. This is a long straddle. Now, I'm just going to go through and show you this cycle real quick of how retail loses money on options and how the market makers are playing it against you. And then we'll look at the actual definition of a long straddle and see how that works. So when implied volatility is low, gamma rises and hedge funds buy long. Often it's on Friday after IV crush. And there's several different strategies they could be using. I'm not saying they specifically do a long straddle. I'm saying in general, that's just what they do. Now, of course, then the stock starts to rise, and then we run up, okay? And then this is where all the inexperienced buyers purchase their options for the most part. So this is when everyone buys in because they expect it to keep going up. And then right at the top, this is when market makers start selling calls. This is when you start seeing volume spike because there's more changing hands because there's some being sold and bought. And then all of a sudden it goes against you. So this upward climb here is when inexperienced buy-ins occur for retail. Now, if you've ever seen it, if you've ever bought a put, have you ever noticed the price goes up and then your put goes up? That's the opposite end of things. That is the other end inflating the premium on the other end of the spectrum. So you got to remember, if the market is moving, the market makers make money. That is, if it's moving, money is being made. So what makes it worse is when we go up and we hit that high point, we get calls starting to be sold and it starts going back down. That's when the money and the premium comes into play, because all the premium is the difference between that price that we hit at the top and where it currently is at that given time. So for example, as we see, after this peak here, we start going down. And as we're going down, this is when apes are averaging down at the same time. So they're getting more difference there as well. So they're likely selling a few on the way down too, but more than likely they're just selling at the top. They have this down stat. I mean, Citadel's algo runs on this. They game it pretty well. So apes average down after the peak, thinking that there may be a second chance. Maybe some bought a couple weeks out. Maybe some are expiring in the week and they've already sold for a loss. Anyways, you get down here to this bottom, and then that's where a lot of accumulation starts occurring. And then sure enough, you start to go back up. This is critical. I've saved my own ass several times because when this happens, it's the fake out. They're luring in more people, more of this inexperienced buy-in because they see it start to rise. More buying in occurs, and then they sell another round of calls right here and buy cash secured puts as well. So this is when you have an opportunity to sell for a loss and minimize the damage. Because if you average down enough, if you're patient and you wait and you don't average down way up here and you average down right here, you may be able to get a low enough cost average as long as you didn't buy right here. If you bought, down here, you might have a good enough cost average to where this bounce here saves you and you break even or slightly under. It's happened to me several times. So if you don't do that and you average down here and you just say fuck it, I think it might continue, and it doesn't, that's when you start to lose even more money because you've spent all this time averaging down just for it to go up, for you not to sell at the fake out. They sell more calls, and then they're extracting all that money you averaged down with. So basically, you can think of it this way. When you buy a call option and it's down 15% after you just bought it, that's 15% of your money that you just put in their pockets. And you can imagine when this happens on a mass scale, that's a lot of money. So could be delaying things a little bit. Can't be helping. We know that for sure. So then, of course, the long and treacherous journey of watching your options bleed out. I can't believe they ended up expiring worthless. And then you get to that Thursday, and you may see a little push for Max Payne. Doesn't always happen, but it tends to be the case. And Max Payne is just saying the number of or the spot in the middle where the most calls and puts are expiring out of the money, basically the most pain to the market makers. Max Payne has not been working lately because the market makers are actually playing off these options very well. As we just saw, shit ton more out of the money than in the money. And that what that does as well, on top of things, is it allows them to reset the FTD clock, and the game starts over again. So let's go ahead and look at what the solution is. So the solution is always to learn the option strategies and which ones are viable at different times. There is a lot of different strategies, and there's not one go-to that works for everything. This takes years of practice and studying market dynamics to understand and learn. However, that does not mean the situation in the current market can't be taken advantage of. So learning and not FOMOing. Do not invest what you cannot afford to lose, and none of this is financial advice. I am retarded. Okay, so the straddle. A long straddle is achieved when buying both a call and a put at the same strike price and expiration date. Because the positions are at the money, they provide the best time value and the greatest absolute volatility exposure. This is a short-term trade with the expectation of an immediate increase in volatility. They effectively double the exposure to volatility when compared with a single option purchase, but have significant time decay. So there's always a downside. So great play for what? If you're expecting some volatility, what's a good play for? GameStop earnings, or any earnings in general that may be known to be volatile around its earnings reporting period. This does not mean it works 100% of the time because, as I mentioned, there's several different option strategies, and you have to figure based on the price action, open interest, and other relevant factors, what's going on before you make your decision. Now, the market moves in three directions: up, down, and sideways. If it's moving up, profit is being made. If it's moving down, profit is being made. If it's moving sideways, there's likely accumulation occurring. So the long straddle, basically an example again, buy one call, buy one put at the same strike. Market outlook is for this strategy would be large move in either direction, which we usually see around earnings. The risk is limited, the reward is unlimited. Now this is a little bit more expensive than the strangle, but I will explain the strangle in the next video, which involves selling calls. So it's a little bit different. So I'll explain that in a different video so we don't get the things intermingled and get all confused. So the increase in volatility helps your position, and the time erosion hurts your position. So these are short-term strategies for the long straddle. That's why, earnings, the benefit of this is we know when earnings periods are going to be, so we can use the straddle to our advantage and maybe buy in a 3 or 4 week window around that earnings period to play off the volatility and make a little extra money in our pocket for some more shares to buy the following week or whenever it averages down. That's basically it. And that's all a long straddle is. It's very simple, but that it's a very short term, specific around volatility. And that's how you do it. You learn to play it with them. You don't just sit here and buy only one side of the equation. If you're not buying the downside, you're only playing half the market. If you're only playing half the market, you're only making half the money. So let's go ahead and utilize the full entirety of the market. Stop ignoring the downside because it does go down. We've seen it. It's a wave type situation, and that means money's being made, and money's being made, and it can be made for everybody, including you, but not if you don't learn the right way to do it. So that's critical. Talk to you next time.